if you look at a digital trading terminal, there's this incredible, almost frictionless beauty to it.
Yeah, it's incredibly sleek.
Right. I mean, you've got trillions of dollars moving across the globe at the little speed of light. An algorithm fires, and capital flows exactly where it needs to go.
Bypassing borders, bypassing physical reality entirely.
Exactly. Zero physical resistance. But if you step away from that terminal and just walk out your door into zip code 12468 in the Bronx, the frictionless reality vanishes instantly.
It's gone.
You hit physical gridlock. You hit economic gridlock.
Mm.
And today, which is May 28, 2026, we are taking a custom deep dive into a massive stack of sources for you.
We've got high-level financial data models, New York City municipal reports, and Attorney General legal filings.
Right, and our mission today is to map that exact collision. We're tracking the algorithms moving billions of dollars in the exact same city where people they can barely get across town. Let's unpack this.
The contrast really is staggering when you lay the data side by side. I mean, we're examining an environment where Wall Street prices risk and probability down to the thousandth of a decimal point.
Yeah.
But they're operating within a municipality that is just struggling with fundamental neighborhood access. The math governing the capital markets is completely decoupled from the physical constraints of the local infrastructure.
Right, so let's start by grounding ourselves in that physical constraint.
Yeah.
The daily squeeze in 10:04:68, because the friction is literal if you're commuting this morning.
Absolutely.
I mean, the Bronx-bound right lane on the Broadway Bridge, it's closed through tomorrow.
Yep.
And Cedar Avenue, between West Fordham and 179th, is just completely shut down for sewer reconstruction every single day from 9 a.m. to 4 p.m.
Not to mention the Cross Bronx Expressway.
Right. The ongoing structural rehab there is adding a solid 10 to 15 minutes to your eastbound morning commute.
And, these physical bottlenecks, they're essentially a mirror for the economic and structural bottlenecks happening in those exact same neighborhoods.
Which is pretty wild to think about.
It is. And it becomes incredibly apparent when we look at municipal resource allocation.
Yeah.
The major local policy shift this week involves Commissioner Tiss and Mayor Mamdani officially splitting the Bronx into North and South Patrol commands.
Right, which affects 10468 directly.
Exactly. The 10468 zip code, which covers the Fordham and Kingsbridge areas, now falls under Bronx North. And the actionable data point here is that nearly 200 new officers have been permanently assigned to this newly drawn district.
But hold on, if we look at the recent Robin Hood Foundation report from our sources, crime is technically down 10% borough-wide.
That's what the data says, yeah.
Yet the Bronx currently has twice the national poverty rate. I mean, we are looking at the worst poverty metrics in a decade. There are nearly 500,000 children in poverty citywide.
Right.
So you have the city deploying a massive wave of new policing resources into a borough where the actual surging metric is structural poverty.
And that right there is the core friction in the municipal data. You have the highest crime and the highest poverty operating in tandem. Yeah. And the primary municipal response is, well, it's just an increase in law enforcement presence.
Which really makes you ask, and this is something for you listening to ponder, when a city is fielding 1 million calls for service, but has 500,000 kids sitting below the poverty line, does flooding a specific precinct with 200 new badges function as an actual cure?
Or is it just managing a symptom?
Exactly. Are they just putting a uniform on a deep structural symptom?
It raises a fundamental question about how a city treats root causes versus, how it just polices the outcome.
Right.
And that tension over resource allocation is currently bleeding into significant local political unrest right now.
It's everywhere.
As we record this, hundreds of people are protesting Mayor Mamdani at Gracie Mansion. The protests are largely driven by his reversal of Adams-era executive orders that protected Jewish and Israeli communities.
Which is obviously a highly charged issue.
Very much so. It's compounded by backlash for his declining to condemn Hezbollah flags at recent demonstrations and skipping the Israel Day parade. But counter-protesters are also present.
Right.
They're defending his administration by pointing to his recent $26 million allocation for hate crime prevention. And all of this is unfolding against the backdrop of an ADL audit reporting 1,200 anti-Semitic incidents in New York City in 2025.
Which is the highest in the nation.
The highest, yeah.
And just to pause here for a second for you listening, our goal today is simply to look at the data driving this pressure cooker. We aren't taking political sides.
No, not at all.
And we certainly aren't endorsing either protest camp. We're purely conveying the events as documented in the source material just trying to understand why the friction in these neighborhoods is hitting a boiling point.
Exactly.
And honestly, that friction isn't just about policing or political protests. It extends into who actually gets to utilize the city's structural assets. I mean, we just saw the city spend millions deploying officers to manage symptoms in the Bronx. But when you look at how the city handles its actual cultural events, you realize local residents are dealing with infrastructure they're actively being priced out of.
Because the structural poverty data directly translates to working-class communities being economically excluded from their own cultural celebrations.
Yeah, it's brutal.
The primary example in the legal filings today is the explosive subpoena dropped by New York Attorney General Letitia James alongside New Jersey's AG.
Right, targeting FIFA.
Targeting FIFA, yes. This is regarding the World Cup matches slated for MetLife Stadium, which, remember, sits barely 20 miles away from 01468.
Just right across the water. And the allegations in this subpoena are staggering. I mean, FIFA didn't just sell expensive tickets. They utilized dynamic pricing for a global sporting event.
Which is a massive shift.
The filings show prices spiked an average of 34% between October and April.
Wow.
They manufactured fake scarcity by deliberately withholding inventory from the public. And that $50 New York resident lottery they hyped
Oh,
up,
the lottery.
it was a joke. They offered 50,000 cheap seats for a population of 8.3 million residents. It sold out in 3 minutes.
We really need to examine the mechanism of dynamic pricing here because it isn't just a simple price tag. These are sophisticated algorithms designed to calculate maximum value extraction from highly inelastic demand.
Wait, explain that. How does it extract the value?
Well, the algorithm essentially reads the desperation of a fan base in milliseconds.
Oh, well.
And it adjusts the cost to the absolute ceiling of what a human will borrow or spend to attend. Because of this, the average ticket is now over $1,000.
$1,000.
Yeah. And in the Fordham and Kingsbridge areas, where the median household income is roughly $40,000 a year,
Right.
a $1,000 ticket is the equivalent of a month of groceries.
Which is just devastating. And these are neighborhoods with incredibly passionate Dominican, Mexican, and West African soccer communities. So the tournament is physically 20 miles across the river, but economically, the algorithm has placed it on another planet.
Completely inaccessible.
And we're seeing the exact same algorithmic extraction with local basketball.
The Knicks.
Exactly. The Knicks are in the NBA Finals for the first time in 27 years after sweeping the Cavs 4-0.
Unbelievable run.
It is. But if you try to get into Madison Square Garden, the secondary market algorithms have pushed tickets to anywhere from $500 to well over $2,000.
Yeah.
So what does this all mean? It means the city that prices you out of the World Cup is doing the exact same thing with basketball.
Yeah.
You wait 27 years and the seat costs your rent.
It represents the complete financialization of civic joy. The capital barrier to entry is operating with ruthless efficiency to maximize revenue, filtering out the actual local working class base in the process.
Right. And if the algorithms are efficiently pricing working class residents out of stadiums, it forces you to wonder where all that extracted capital is actually flowing.
Because it's going somewhere.
It certainly isn't staying in 10468. And the financial models in our source stack point to one massive frictionless destination: big tech infrastructure.
The scale of the capital moving into the AI infrastructure megacycle is, well, it's difficult to overstate.
Give us the numbers.
For 2026, big tech's committed capital expenditure, their CapEx spend, is projected at $725 billion.
$725 billion.
Yes. That is a 77% increase from 2025. This massive locked-in capital flow is exactly why Goldman Sachs is aggressively pushing their S&P 500 target to 8,000.
Because AI is driving the whole index.
Right. AI infrastructure is driving roughly 50% of the entire index's earnings growth.
But retail investors usually look at this and just, buy NVIDIA.
Sure.
Or they look at the memory space, like Micron and SK Hynix crossing $1 trillion market cap. But the data shows institutional capital, the smart money, they aren't just chasing the chips.
No, they're looking at the physical constraints of those chips.
Right.
They are looking at the power grid and thermal dynamics. Let's break down the mechanics of why this matter.
Please.
When you cram thousands of next-generation H100 or B200 GPUs into a single server rack, you are creating an unprecedented concentration of heat.
Right, they run insanely hot.
Exactly. If you run these models without advanced cooling, the silicon will literally melt itself. Legacy air cooling systems in older data centers just cannot handle the thermal density.
So the compute power of AI is entirely bottlenecked by physical infrastructure.
Exactly.
You need advanced liquid-to-chip cooling, and you need a massive amount of electricity just to run those cooling systems.
Right. The hyperscaler budgets for 2026 have allocated $20 billion specifically for power infrastructure and $25 billion for cooling.
Wow.
The institutional capital is flowing directly into the picks and shovels companies that are solving these specific thermodynamic problems. We're looking at companies like Vertiv, ticker VRT, Eaton, ticker ETN, and GE Vernova, GEV.
Vertiv and Eaton are positioned beautifully here because they ride both the power and the cooling budgets.
Yes.
Instead of trying to guess which AI software startup is going to dominate the market in 5 years, institutional money is just buying the companies that build the pipes and the liquid cooling manifolds.
Right. If we connect this to the bigger picture, the real play isn't the AI software. It's the companies physically keeping the servers from melting.
That's a great way to put it.
It is a steady, predictable, locked-in capital spend that faces virtually zero risk from software competition.
But steady, multi-year infrastructure bets are only one side of the Wall Street coin.
Very true.
Because while they park billions in server cooling, the sources show another sector where Wall Street employs pure probability math to capture rapid, massive returns overnight. We really need to talk about biotech binary trades.
Yeah, this sector offers actual 10x potential, but it requires understanding why the market systematically misprices specific FDA approval dates.
Also known as PDUFA dates, right?
Exactly, PDUFA dates.
Because the market tends to treat every single FDA approval date like a lottery ticket, pricing in massive risk. But why does that mispricing happen?
It happens because risk algorithms often lack nuance. They tend to indiscriminately flag all pharmaceutical FDA dates as high risk, failing to distinguish between, say, a highly speculative, brand new experimental drug and a safe, routine label extension for a drug that has already been on the market for years.
So they treat them all the same.
Right. When you identify the routine extensions, you find setups with incredibly high historical base rates of approval that the market is treating as coin flips.
Let's break down the 3 specific setups the models highlight, because the risk-reward profiles here are fascinating. First up is Mankind, ticker MNKD.
May 29th.
Right, May 29th. They're seeking approval for a pediatric version of an inhaled insulin. The active ingredient is already FDA approved for adults, and the phase 3 trial was positive.
So it's a known quantity.
Exactly. Because of that, the historical base rate for this specific type of application gives it an 82% probability of approval. The options market is implying a 28% gain on a win or a 42% drop if the FDA rejects it.
The second one is Syncor, ticker CING, on May 31. This is a reformulation for an ADHD treatment. Again, this is a known molecule. The company is simply proposing a novel delivery mechanism. The historical math gives this a 72% probability of approval.
But the swings on this one are wild, right?
Violent swings. Because Sancor is a microcap stock with very low liquidity, the models project a 55% spike on approval or a 62% crash on a rejection.
And finally, there's Spiro Therapeutics, ticker SPRO, on June 18th. This is a resubmission for a UTI treatment.
Right.
They're backed by a positive confirmatory phase 3 trial and have a major partnership with GSK. The historical approval rate for this specific clinical setup is around 80%. The expected move, up 45% or down 55%.
Now, if an investor puts all their capital into just one of these names, they're taking on isolated binary risk.
Pure gambling.
Basically. But the underlying edge relies on basket math. The data models utilize a Monte Carlo simulation for this.
Let's unpack the Monte Carlo simulation for a second for everyone listening, because it sounds intimidating, but the logic is brilliant.
It really is.
It essentially means a computer program runs this exact basket of 3 FDA decisions 100,000 different times. It factors in the 82, 72, and 80% win probabilities just to see what the most likely outcome is over a massive sample size.
Precisely. And when you run that simulation on an equal weight basket of Mankind, Syncor, and Sparrow, the mean return of the entire basket is positive 21%.
That's huge.
It is. More importantly, there's an 80.1% probability that the basket as a whole generates a positive return.
Wow.
By combining independent, high-probability binary events, you smooth out the risk of a single catastrophic rejection.
But, and this is a big but, The sources include a very strict warning about how this math is applied in the real world.
Yes, they do. The math only protects the portfolio if the sizing is violently disciplined.
Violently disciplined.
Institutional traders only allocate 1% to 3% of their total risk capital per name. Because if a retail trader bets half their account on an 80% probability and hits that 20% failure rate,
They're wiped out.
they're completely wiped out. Sizing is what separates probability trading from gambling. This is math, not hope.
And speaking of probability trading, all of these microcatalysts, the AI valuations, the biotech FDA dates, they're entirely dependent on the macroeconomic weather.
Which is about to shift.
Right. Which brings us to the most immediate high-leverage event of the day. Everything we just talked about hinges on a single number dropping today at 8:30 a.m., the PCE and GDP data print.
The macro environment is sitting on a knife's edge right now. April's consumer price index came in hot at 3.8%, and the 10-year Treasury yield is elevated at 4.56%.
Okay.
So the entire equities market is bracing for the core PCE print, which is the Federal Reserve's preferred inflation gauge. It's a pure binary macro setup.
Right. The models were looking for a hot versus soft print. If it prints hot, meaning inflation comes in at 0.30% month over month, or higher equity multiples are going to crack.
The market's 8-week winning streak likely ends right there.
But if the print is soft, 0.20% or below the blow-off top continues, and the massive AI rally extends,
The big question for traders is how to position for an event that could violently swing the market in either direction. The institutional playbook detailed in our sources relies on an options straddle.
let's define the mechanics of an option straddle, because it's a perfect tool for this environment.
Sure.
It essentially means you are buying a call option, a bet that the market goes up, and a put option, a bet that the market goes down at the exact same time.
Right.
You don't care which direction the market moves. You just need it to move violently enough in one direction to cover the cost of both bets.
And the viability of a straddle entirely depends on the cost of volatility.
The VIX.
Exactly. Right now, the VIX, which operates as the market's fear gauge and prices the cost of options insurance, it's sitting at historically cheap levels around 17.
Which is crazy low.
It is. Because that insurance is currently so cheap to buy, a long volatility straddle going into this specific PCE print carries a 57% probability of profit.
And the playbook maps out the exact scenario split. The models give a 35% probability that inflation comes in soft. If that happens, the playbook is purely risk-on.
You deploy capital into the memory complex, the AI power and cooling picks like Vertiv we discussed, and speculative space stocks.
Conversely, the models assign a 40% probability to a hot print.
And if inflation runs hot, the playbook flips to risk off. You utilize instruments that profit from market panic and sell-offs.
So that means buying VXX, which tracks short-term market volatility.
Yep. Or purchasing put spreads on the SPX, which is the S&P 500 index.
But the absolute rule the sources stress here is patience. You do not predict the print.
Never.
You do not size your trade at 8:29 a.m. Think of it like driving through an intersection.
That's a good analogy.
Right. You don't stomp on the gas a block away hoping the light turns green by the time you get there.
Yeah.
You wait, you visually confirm the green light, and then you accelerate.
You trade the market's reaction to the data, never your forecast of the data. And that discipline highlights the stark divergence taking place today. On the surface, the S&P 500 is hitting record highs, and retail investors are experiencing euphoria.
Oh, total euphoria.
But beneath the surface, institutional money is utilizing options straddles and the VIX to quietly purchase cheap insurance.
They're structurally positioning themselves for a potential ceiling.
While the retail crowd remains completely unhedged and exposed.
It really is a tale of two entirely different realities. And it brings us full circle to where we started this deep dive.
It does.
We've mapped out the physical gridlock and the deep, persistent structural poverty in the Bronx. We've looked at the sophisticated dynamic pricing algorithms, excluding working-class residents from the World Cup and the Knicks.
And we've traced the trillion-dollar algorithms pouring institutional capital into liquid server cooling and biotech probability math.
It reveals a system where every single variable is quantified by those with capital.
Every decimal point of inflation.
Right.
Every historical FDA base rate, every megawatt of cooling capacity, and every dollar a fan is willing to overpay.
Wall Street prices every single micro risk down to the absolute decimal. But when you step back and look at the physical streets of 10468, when you see local event tickets skyrocketing out of reach and policing increasing, while child poverty steadily worsens.
Yeah.
It leaves you with a final, lingering question to chew on. We've seen that Wall Street prices every single risk down to the decimal, from biotech FDA approvals to inflation prints. But in a financial ecosystem that can calculate the exact 57% probability of an option straddle at 8:30 a.m., who is calculating the long-term risk of pricing a city's own residents out of their community.
It is the one variable the algorithms haven't been programmed to solve.
Thank you so much for joining us on this deep dive. Keep questioning the numbers behind the headlines, keep looking for where the friction really is, and we'll see you next time.